Bad news, but also really good news. We just had another bank collapse. Regulators closed New York Signature Bank, citing systemic risk. And this wouldn't matter much if it was just a small bank, but this bank has $110 billion in total assets. And we will get to the good in just a moment, but look at this as well. People lining up to pull money out of First Republic Bank in Brentwood, LA this week. This did not look good this morning. Look at that line. So many people. You don't want to be one of these people. And now here is the really good news. A joint press release, joint statement by Treasury, Federal Reserve, and FDIC. Today, we are taking decisive actions to protect the U.S. economy by strengthening public confidence in our banking system. That is good. This step will ensure that the U.S. banking system continues to perform its vital roles of protecting deposits and providing access to credit to households and businesses in a manner that promotes strong and sustainable economic growth. Okay, sounds good, but doesn't really mean anything. After receiving a recommendation from the boards of the FDIC and the Federal Reserve and consulting with the president, Secretary Yellen approved actions enabling the FDIC to complete its resolution of Silicon Valley Bank, Santa Clara, California, in a manner that fully protects all depositors. Depositors will have access to all of their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. That is a very good outcome. We are also announcing a similar systemic risk exception for Signature Bank, New York, which was closed today by its state chartering authority. So that's not good. All depositors of this institution will be made whole. That's very good. As with the resolution of Silicon Valley Bank, no losses will be borne by the taxpayer. Also good. Shareholders and certain unsecured debt holders will not be protected. That's good. Senior management has also been removed and they should be investigated too. Any losses to the deposit insurance fund to support uninsured depositors will be recovered by a special assessment on banks as required by law. Finally, the Federal Reserve Board on Sunday announced it will make available additional funding to eligible depository institutions to help assure banks have the ability to meet the needs of all their depositors. That is also good, but I want specifics. The U.S. banking system remains resilient and on a solid foundation in large part due to reforms that were made after the financial crisis that ensured better safeguards for the banking industry. Those reforms combined with today's actions demonstrate our commitment to take the necessary steps to ensure that depositors' savings remain safe. So far, from what I just read, seems like it's almost an ideal outcome. Taxpayers don't need to pay for anything. All of the deposits will be accessible on Monday. That is perfect. And they did mention that they are doing something to make sure that other banks will be fine, but they didn't give specifics. That is a little bit worrisome still, because I would still be taking my money from a small bank and putting it into a bigger bank, because if they have multiple more bank runs, will they really make every depositor whole? I don't know about that. But so far, it looks like the big bad crisis has been averted and the government did not mess this up, which usually you never want to underestimate the government's ability to mess up even the simplest things. Well, here looks like it's going to be okay, but there are more things to be concerned about, so let's dive in. There are still other banks that are potentially in a worse position than Silicon Valley Bank. For example, you look at the assets right here, and of course, Silicon Valley Bank was not in a good position, and this institution also is not in a great position. I'm not saying that they are going to go out of business or anything like that. That data is from Bloomberg, specifically not from Meet Kevin. But that is not looking exactly great. And this bank, Signature Bank, I didn't really see anyone talking about this, and all of a sudden, it's now closed. While I want to believe that everything's going to be fine from now on, which is more likely now, I am still on guard, and things could still go very badly. Lehman Brothers, for example, filed for bankruptcy on September 15th, and right here is S&P 500, and as you can see, nothing really happened yet in the markets. It took a few weeks until we saw the actual big, massive fall, and the stock market kept falling for quite a while. So if this ends up being systemic, we won't really know probably for a little while. We have new information, and it doesn't seem like the taxpayers are not going to pay anything. It appears to me they will. If you really read between the lines, technically they won't, but practically I think they will. So what the Fed did is it created this new bank term funding program. It has $25 billion in it, and it appears to me what they are doing is they are taking some of these bonds, for example, that will mature in 5-10 years, and the Fed is going to take some of those, but the Fed perhaps is going to give the bank not the fair value of these bonds, but how much the bank would get from these bonds once these bonds mature. I'm not exactly sure, but that is what it sounds to me like. Also, what is a bit scary, it is only $25 billion. That just covers the Silicon Valley Bank probably, and that other bank that just collapsed as well. What if there are more banks that go under? They would need to expand this program. But clearly, the Fed wants to avoid a systemic issue, so that seems to be stabilizing the economy, at least for now. Meet Kevin also thinks this is a bailout. Keep in mind, I'm reviewing everything live as it comes in, so I may change my mind completely later, but so far, to me, it looks more like a bailout, although in the long term, if these bonds eventually mature, sure, yeah, you could say there is no bailout then. Here's what Ross says. Banks can hold their loans to maturity, and there is no reason to force sales to realize losses, unless, of course, there is a bank run, in which case you have to sell those, and there are losses then. The Fed just made sure that won't happen. They will provide liquidity if necessary, protecting the banks. That's what they should be doing since they made this mess. So many people think that's a bailout, although what Ross is saying here, I think really makes sense. It's a takeover. Management and shareholders wiped out. They are running the bank, and the Feds have liquidity. The assets are the customers. So if you look at it that way, okay, yeah, it's not a bailout, but only because the Fed has so much liquidity, which is provided by the taxpayers, and the Fed can avoid selling all of these long-term securities that the Fed can hold until maturity. So if you look at it that way, yeah, not a bailout. But in reality, no one in their sane mind would pay above the market price for these bonds unless they actually want to own the bank. So for now, I'm going to stick with, I think it's a little bit more of a bailout, but it's sort of cleverly done so we can tell the public that it is not, because technically it's not, right? But if you have more information come in, I'm happy to review that and then change my mind. This is not a final opinion of mine. What is clear is that the big bad crisis has been averted. That is the important part for now. And remember that bank, First Republic, that I showed you in the beginning of this video that was experiencing a bank run with many people lined up? Well, here's what this bank just said. In light of recent industry events the last few days have caused uncertainty in the financial markets. We want to take a moment to reinforce the safety and stability of First Republic reflected in the continued strength of our capital, liquidity, and operations. Our capital remains strong. Our capital levels are significantly higher than the regulatory requirements for being considered well capitalized. I mean, that's what they have to say, so that doesn't really mean that much. Our liquidity remains strong, again, doesn't mean that much, although, in addition to our well-diversified deposit base, we continue to have access to over $60 billion of available unused borrowing capacity at the Federal Home Loan Bank and the Federal Reserve Bank. Having seen these two banks just now being closed by FDIC, I would imagine they just looked at this bank, and this bank is not closed yet. So it looks like they are probably going to be fine. Jason is a well-known venture capitalist, and Elon Musk also knows him. And he was extremely worried. Here's what he says now. Two banks collapsed in the last 48 hours. The Fed waited until before markets opened in Asia to announce a blanket backstop for all depositors. I think that was a good move to wait because you have a little bit more time to work everything out, and then you announce it, and then things calm down. Downstream effects were instantly felt. Payroll, systems, Etsy, etc. It would have been 20 banks in a week and chaos if they did nothing. I am not sure if it would have been that bad, but that is certainly a possibility. The risk right now certainly is a lot lower. Did the Fed do the right thing? I'm not going to argue that. What I'm going to say right now is that the markets are going to not be as upset as they would have been. I wouldn't rush to celebrate yet. I am still staying on guard, but it's looking good. And this is the Tesla stock buying opportunity explained by Elon Musk. Like and subscribe if you haven't yet. And I'm really happy that there is not going to be a wide collapse. At least that's what it looks like right now. Hopefully it stays that way.